Hello traders, Gary Wagner here for Trending Markets. Approximately 15 minutes after 11 in Honolulu, 4:15 in New York. Equities markets have closed on Wednesday, March the 2nd, 2016, with the Dow Jones average closing up about 34 points on the day. Did close higher, very nominal move in the market, just below 16,900 at 16,899. 0.2% in terms of the actual rise today. Same correlation, of course, in the Standard & Poor's. 1982.75 up 4.75 points or 0.25%. But the key, as far as I'm concerned right now, is how the market has been trading effectively above different levels that we have qualified as prime resistance areas that I believe are now support. And the key area that we're looking at right now is about 1270. So traders, I did make a recommendation yesterday that if we had any kind of firmer opening in the marketplace itself, to go ahead and initiate a long position in the Standard & Poor's. Now the open was at around 1976. Traders taking that call on the open would have waited a couple of ticks, so they're in roughly, call it even at 1980. Markets trading at 1982.75. For those that did not take that call, you can go ahead and enter the market, enter it from the long side. And in terms of stop placements itself, you're going to want those stops under 1970. That would be the critical area that we would be looking at, that we need to hold. Now, in terms of upside targets, to do that, we really want to look at not only our Fibonacci retracement, but also our 200-day and 50-day moving averages. But the first thing that I do want to talk about or to look at is going to be our Fib retracement, because as you know, we have two basic areas, 23% at 2045, and then we have our 38% retracement, and that's sitting just above 2004. Now, of course, this Fib retracement is based upon the August meltdown from the recent highs that it hit back in the August meltdown, which come in roughly above 2100, but 2110, that area, down to these lows that were achieved, as I said, back in August and September of last year. Now, when the market came down on this particular occasion, we did make more drastic lows. We did have a lower low. And so to me, that's the real qualifier, because we now have a lower low in place. We do not have a higher high in place. And so we don't have the firm confirmation that we're back in any kind of a bull market. In fact, for that, we really need to look at the 200-day moving average. And so traders, this is actually the chart that I'm talking about. This, of course, it's a daily chart, but on this daily chart, besides having this one retracement area, we have also added two basic moving averages. First moving average, of course, is this dotted line, and this is our 50-day or short-term moving average. This solid blue line, of course, represents our 200-day moving average. Now, the first real indication to us that we had some kind of a rally underway that could be sustained. Of course, you had a nice move in the market, but something that was sustainable is really when we saw this market move above the 200-day moving average. We recommended initiating a long position yesterday. We're putting it in writing today. As I said, market's trading roughly at 1982, and my sense is at minimum, we should be able to see this market move to the next real level of resistance, which sits at around 2000. However, it would not be until we effectively broke above the 200-day moving average, which is currently at 2018, before we could say that we were in a bona fide rally. And traders, it's quite easy to see why that 200-day moving average is so darn important. Take a look at this weekly chart, and you can see this, of course, is 2012. Here is when we first see this marketplace. It traded below it here, above it here, but here is really where we start to get this market moving into a defined bullish market and a defined bull market. Not only bullish, but a bull market. So as long as it's trading above this 200-day moving average, you can really say with some degree of certainty on a technical basis, we've got a bull market. Now, we had the first extreme that came in. This, of course, was in 2014 when the market went from these tops here at about 2000 and then retraced to about 1800. Now, lo and behold, if you take a look at these lows here, they match up quite eloquently with these current lows here. So we can see that on a very, very long-term basis where this support came in technically. Now, the fact that it broke through the 50-day, well, that's really important. There's no doubt about that. But when we take a look at this longer-term moving average, that, of course, is the moving average that we want to take out. These, of course, have been adjusted because they're not in days, they're in weeks. So it's a rough guesstimate, so to speak, in terms of our 50 and 200-day moving average. But traders, I recommend for those of you that got into the market this morning on the firm open, as I recommended yesterday, maintain your current long position, stops below 1970. For those who did not, I will include this as a trade alert within the members page itself so you can get specific details on that. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.